Welcome to the monthly View from the Edge for January 2023. I'm Fritz Folts, the Chief Investment Strategist here at 3Edge, joined here once again today by Eric Biegeleisen, Director of Investment Research and Deputy Chief Investment Officer here at 3Edge Asset Management. Today, Eric and I will provide our firm's most recent outlook for the global capital markets, which is based on our proprietary 3Edge research model. Have a great deal to cover here today, so let's get started. And we've now turned the page on 2022. In this new year, investors remain focused on inflation and the Fed. The Financial Times aptly described 2022 as the year that ultra-low interest rates and quantitative easing died with the arrival of high inflation. In 2022, we were introduced to levels of inflationary pressure not seen in decades. This forced central banks to raise interest rates at the fastest pace since the 1980s, and it's certainly conceivable that this rather sudden change in the cost of money might be with us for the foreseeable future. So as we kick off the new year, we've seen equity markets rally, and actually U.S. equity markets outperform U.S. equities thus far in 2023. As inflation has come down from its peak levels since mid-2022, investors have become hopeful that the trend will continue, inflation will continue to decline, and the Fed can engineer a soft landing. Even though the Fed insists that the most likely path for monetary policy this year would be one where it continues to raise rates in the early months at least, then potentially pauses but holds rates at current higher levels, investors don't seem to be buying it. They are more of the mind that the Fed is near the end of tightening and will soon be able to stop raising interest rates and even begin to cut rates later in the year. So that's a lot to digest. So let me bring Eric in here now. And why don't we start by looking at our matrix, which shows the major asset classes that we look at, and show us any changes, as we enter January.
Great. Thanks, Fritz. That was a great summary. So we see just a couple of items moving here. We see European equities moving from the -1 spot up to the +1 spot. So that's moving up 2 spots. China equities still remaining in that +1 spot. While U.S., developed Asia, and India remain in that -1 spot. Rates, credit, unchanged. We can dive into these, I'm sure. Cash still looking fairly attractive now with a yield over 4%. Gold moving up to a +1 spot, which is interesting, and commodities holding there as well. So lots to discuss, I'm sure.
Yeah, absolutely. Great. So let's take a look at the equity asset classes that have our attention here in January. So what is the model indicating?
Yeah, so starting with U.S. equities, we saw obviously a correction in U.S. equities in 2022. Large cap stocks like the S&P 500 down around 18%, mid caps down 13%, holding up, I guess, a little better, and small caps down over 20%. Nowhere really to hide in terms of the size. We still find U.S. equities to be significantly overvalued by our measure. I know we've said that for months and months and months, and you'd think, oh, well, the market's sold off, so maybe they're more reasonably valued. Not in the manner in which we calculate. We would be seeing the beginnings of more fair valuation with an S&P 500 around 3,000. And just to be clear, that is not a prediction of where we think the market's going. Just saying from a mathematical construct, that would be closer to that range. From an economic lens, monetary tightening by the Fed is also weighing negatively on the outlook, like you just discussed. And investor behavior also isn't helping, as the S&P still remains firmly below its 200-day moving average, which in the context of historical bear markets, crossing back above would be a necessary, though likely not sufficient on its own condition, to suggest that we are out of the woods for the current bear. We'll look, as will many market watchers, to the next inflation readings and the corresponding response by the Fed to gain a sense of how much longer this tightening cycle will carry on. When will we hit peak rates, like you just talked about, the longevity of holding at these levels, and ultimately the potential for a reduction in rates and or balance sheet expansion. We'll also be keeping an eye out for the upcoming earnings season, which began on Friday this week, to gain a sense of earnings themselves, but also future guidance by U.S. corporations for 2023.
Excellent. A lot to digest there in the U.S. equity land. Let's look at European equities, which, as I said, they began to rally late last year, off to a strong start here in 2023. What is the model telling us about European equities? They certainly look like they've improved in terms of our outlook.
That's right. Yeah. Our outlook has moved to a slightly positive one for European equities. Unlike the valuation levels in the U.S., we find the valuations in Europe much more reasonably valued. Though this alone isn't really a timing instrument. So that's not necessarily new. So what has changed? So what we're seeing is an about face by inflation prints out of the European region. They peaked at about 10.6%, and now there's two prints well below this level, suggesting efforts by the region are starting to pay off. And our European model is very, sensitive, particularly sensitive to inflation measures. We've also seen a turnaround in our outlook for the euro, which is now somewhat positive, which boosts the overall equity outlook. And the winter is turning out to be much more mild in the region than originally expected, and combined with a reduction in energy prices that we've witnessed is suggestive that the sell-off in the region perhaps went too far in advance of the winter, and the recent positive performance in the region may just begin. Maybe more to go there.
Yeah, I think it's helpful. If you go back to what people were saying before winter set in Europe, and just how dire
that's right
the predictions were, and that really hasn't materialized. So maybe another reason why they're able to rally here.
Great point.
All right, let's look at China and the emerging market equities. Again, both of which have rallied here in 2023. We've seen China reverse course on its COVID-0 policy. We've seen the U.S. dollar back off, which should be helpful to EM countries, EM equities. So what is the model saying in China and the emerging markets?
This is the other equity asset class we find somewhat attractive at this time. We still find Chinese equities to be undervalued by our measure, despite the gains it's already made from its October lows. The relaxation of China's zero COVID policy, which you just referenced, has allowed the domestic economy to show some signs of life, and may ultimately allow China to become that global engine of growth that it's been in the past. However, risks remain, as the true number of active cases and overwhelmed hospitals and fatalities is likely heavily understated. And as we know, an unexpectedly high caseload could lead to future shutdowns or the inability for folks to get back to work, leading to further disruptions. But speaking more broadly about emerging market equities, if we've seen the peak in the US dollar, it had this recent climb and then peaked, and it's come off somewhat, then non-US equities like emerging market equities, and possibly even more specifically Latin America, who reacted sooner than the U.S. Federal Reserve to the early inflationary pressures, may benefit most from this recent pullback in the dollar we've seen, and may be in a more favorable position to lower interest rates should inflation truly begin to moderate.
Excellent. All right. So those are probably the three most important equity asset classes. So let's shift gears and look at fixed income. I mean, people talk about what happened in equities last year, but the rise in U.S. Treasury yields was really dramatic in 2022. And so what is the model telling us now? I mean, people are saying, well, bonds are back. What is the model saying?
Yeah, well, because the Fed aggressively increased interest rates to combat inflation throughout 2022, the yield curve for U.S. Treasuries rose significantly throughout the year and inverted. So just to be clear here, right, we started the year in 2022 with an upward sloping yield curve. So the 3-month yield was zero-ish, and the 10-year yield was around 1.5%. You fast forward to the end of the year, and the yield on the 3-month popped up to 4.5%-ish, and a 10-year at just under 4. So that's a big move in a short time frame, and generally that's not a good thing for equity market valuations or bonds for that matter. Also in 2022, real yields, that is the nominal yield adjusted for inflation, rose from around -1% to positive 1.5%, right? That's a really large move as well. Therefore, unlike last year, TIPS now earn a positive real return over and above CPI, which is still above 6%. Interestingly, the market's inflation expectations just remain anchored, though, well below the current inflation rate at just over 2% when you look at those break-even numbers, which suggests the market has a good deal of confidence in the Fed's ability to rein in inflation and to do it rather quickly. Should that outlook change because it becomes clearer that bringing CPI into the 2% area in a year isn't going to happen, and we see a rise in these inflationary expectations, that could result in further capital appreciation for TIPS investors. this will also be a positive for gold, which I'm sure we'll talk about.
Yeah.
Just want to touch on credit. The model research just continues to indicate caution there in the corporate credit market. Should the U.S. economy slow and pressure corporate earnings, then corporate credit spreads could widen again, and that would likely hurt investment grade bonds as well as high yield bonds.
Yeah, you've just got, the cost of money has risen dramatically over the past year. So that'll be interesting to keep an eye on. So let's look at real assets, gold and commodities. I know that we've moved gold up a notch, right, in terms of its attractiveness. What is the model showing us there?
Right. So just to recap, right, in 2022, we saw, and we just spoke about this rise in real interest rates from the -1 to the +1.5. The interesting is that they've kind of leveled off now, these real yields. Right. Indicating this potential pause, which would be a positive development for gold. And we've actually seen gold prices climb recently, and maybe it's in part due to that. Should the Fed begin to relax its monetary tightening and or even indicate the timing for relaxing, the US dollar could weaken further, which could also be seen as a positive factor for gold. And as we know, gold may actually act as a haven in tumultuous times, whether that's due to market liquidity issues or during times of heightened geopolitical tensions, thinking like China, North Korea, Russia, these typical flashpoints. And so, that just bolsters the case for it as well. And lastly, it's worth noting that many governments and central banks have recently been buying gold, much more so than normal. And that's also been supportive of the price of gold.
Great. Commodities, did we cover that yet? No, right. We didn't, did we?
We haven't. We'll do it now.
Let's cover commodities. Absolutely.
Commodity prices weakened, right, with the decline in the price of oil, which was likely triggered in part by the U.S. government's drawing down our U.S. Strategic Petroleum Reserve, the SPR. Of course, the U.S. government will now need to refill that SPR, which should be supportive of creating a price floor at the minimum for the price of oil, if not helping it up more. This combined with China's reversal of its COVID-0 policy that we touched on already, and the potential restart of the Chinese economy, that could increase demand, that could help push oil prices higher in the short term. Other commodities such as food and agriculture we've talked about may also benefit from the ongoing maelstrom that was brought on by Russia's invasion of Ukraine that's still ongoing almost a year in, as well as the continued severe drought conditions we've seen around the globe. In 2023, commodity prices will be reliant on the path of the global economy and at risk if the monetary tightening by the world's central major banks triggers a material economic slowdown or even a global recession. So, we feel like it's on this knife edge and it could really go either way. And it's going to be in response to some of these items we talked about.
Yeah, that's a good explanation. Thank you for that. So, all right, well, great. Thank you, Eric. Thanks for the update on our outlook as we begin 2023. We'll also be keeping a close eye on the path of inflation and interest rates as we make our way through the year. So that will do it for Eric and me. We'll be back again in February with the next edition of the 3 Edge View from the Edge. If you would like a hard copy, our full View from the Edge newsletter for January 2023, you'll find that on our website, which is at 3edgeam.com. And as a reminder, our entire library of video content is always available on our 3 Edge YouTube channel. So on behalf of Eric and everyone here at 3 Edge, thanks for listening.